This is chapter 10, video 2 for the lecture. Okay, this is the checkup corner, payroll entries. So we have the situation, wages of $180,000 for week ended March 20. All $180,000 of wages are subject to Social Security and Medicare taxes, while $30,000 of wages are subject to federal and state unemployment taxes. So the tax rates are as follows. Social Security 6%, Medicare 1.5%, unemployment for the state is 5.4%. Federal unemployment compensation tax is going to be 0.8%. So here's what this will look like. Wages of expense of $180,000. So we're going to debit it. Social Security tax $10,800, and all that was $180,000 times 6%. Medicare tax payable is $2,700. Employee federal income tax payable $38,500. Wages payable $128,000. Part B of that, it says payroll tax expense $15,360, and Social Security payable $10,800. Okay, Medicare tax payable $2,700, state unemployment tax payable $1,620, and federal unemployment tax payable $240. Okay, so that's how we would do that. Paying payroll, companies pay employees either by electronic funds transfer or by issuing payroll checks. With electronic funds transfer, the employee's net pay is electronically deposited into their bank account each period. The employees receive a payroll statement summarizing how the net pay was computed. Most companies use a special payroll bank account for payroll. An advantage of using a separate payroll bank account is that reconcile the bank statement is simplified. In such cases, payroll is processed as follows. The total net pay for the period is determined. The company authorizes an electronic funds transfer from its regular bank account to the special payroll account for the total net pay. Individual EFTs or payroll checks are dispersed from the payroll account. Internal controls for payroll. Some examples of payroll controls include the following. The hiring and firing of employees should be properly authorized and approved in writing. All changes in pay rate should be properly authorized and approved in writing. Employees should be observed when arriving for work to verify that employees are checking in for work only once and only for themselves. Employees may check in for work by using a time card or by swiping their employee ID card. A special payroll bank account should be used. Employees' fringe benefits. Many companies provide their employees benefits in addition to salary and wages earned. Such fringe benefits may include vacation, medical, retirement benefits. The cost of employee fringe benefits is recorded as an expense by the employer. Vacation pay. Most employers provide employees vacations, sometimes called compensated absences. The liability to pay for employee vacations could be accrued as a liability at the end of each pay period. However, many companies wait and record an adjusting entry for accrued vacation at the end of the year. So vacation pay, here's how you would account for this. Vacation pay expense, $325,000. Vacation pay payable, $325,000. And this is the entry, accrued vacation pay for the year. If employees are required to take all their vacation time within 1 year, the vacation pay payable is reported as a current liability on the balance sheet. If employees are allowed to accumulate their vacation pay, the estimated vacation pay payable that will not be taken within a year is reported as a long-term liability. When employees take vacation, the liability for vacation pay is decreased by debiting vacation pay payable, salaries or wages payable, and other related payroll accounts for taxes and withholdings are credited. Pensions is a cash payment to retired employees. Pension rights are accrued by employees as they work based on their employee's pension plan. Two basic types of pension plans are defined contribution and defined benefits plan. Defined contribution plan is the company invests contributions on behalf of the employee during the employee's working years. Normally, the employee and employer contribute to the plan. The employee's pension depends on the total contributions and the investment returns earned on those contributions. One of the more popular defined contribution plans is the 401k plan. Under this plan, employees contribute a portion of their gross pay to investments such as mutual funds. A 401k plan offers employees two advantages. The employee contribution is deducted before taxes. The contributions and related earnings are not taxed until withdrawn at retirement. So in most cases, the employer matches some portion of the employee's contribution. The employer's cost is debited to pension expense. So here's an example. Pension expense is debited for $50,000, and because it's 10% of the monthly salaries, cash is going to be put in there from, well, cash is going to be moved, is going to be credited. Okay, in a defined benefit plan, the company pays the employee a fixed annual pension based on a formula. The formula is normally based on such factors as employee's years of service, age, and past salary. In a defined benefit plan, the employer is obligated to pay for or fund the employee's future pension benefits. The pension cost of a defined benefit plan is debited to pension expense. Cash is credited for the amount contributed or funded by the employer, and any unfunded amount is credited to unfunded pension liability. So here's an example. So pension expense, $80,000. And don't forget, expenses go straight to the income statement. Cash is going to be credited for $60,000, and then the unfunded pension liability for $20,000. So there's the annual pension cost and contribution. So in the unfunded pension liability is to be paid within 1 year. It is reported as a current liability on the balance sheet. Any portion of the unfunded pension liability that will be paid beyond 1 year is a long-term liability. So post-retirement benefits other than pensions. So here are some examples. Post-retirement benefits may include dental care, eye care, medical care, life insurance, tuition assistance, tax services, legal services. There's others as well, but these are kind of the basic ones. Some places of employment offer different options. The estimate of the annual benefits expense is recorded by debiting post-retirement benefits expense. If the benefits are fully funded, cash is credited for the same amount. If the benefits are not fully funded, a post-retirement benefits plan liability is also credited. The financial statement should disclose the nature of the post-retirement benefits liability. These disclosures are usually included as notes to the financial statements. An installment note is a debit that requires the borrower to make equal periodic payments to the lender for the term of the note. Each note payment includes the following: payment of a portion of the amount initially borrowed, called the principal, payment of interest on the outstanding balance. At the end of the note's term, the principal will have been repaid in full. Installment notes are often used to purchase specific assets such as equipment and are often secured by the purchased asset. If the borrower fails to pay the note, the lender has the right to take possession of the pledge asset and sell it to pay off the debt. Installment notes that are secured by purchased assets are sometimes called mortgage notes. When an installment note is issued, an entry is recorded debiting cash and crediting notes payable. Okay, so here's an example. A note with a principal amount of $24,000, 6% interest. The length of the note is, or term of the note is 5 years. Annual payments of $5,698. So we're going to cash $24,000. We're going to debit cash for $24,000, and we're going to credit notes payable for $24,000. Issued installment note for cash. Periodic payments. The preceding note payable requires Lewis Company to repay the principal and interest on equal payments of $5,698 beginning December 31 of year 1 for each of the next 5 years. Each installment note payment includes an interest and principal component. So this is what it would so hang on one second. We'll get to that here in a bit. Periodic payments. The interest portion of installment note payment is computed by multiplying the interest rate by the carrying amount or book value of the note at the beginning of the period. The principal portion of the payment is then computed as the difference between the total installment note payment cash paid and the interest component. So here's what this will look like. This is what I was getting to. So $24,000 deduct $56.98 interest expense. Okay, don't forget, anytime you see an expense, that goes straight to the income statement. So we're gonna expense out each of these amounts totaling $44,90. Here's a decrease in the note, B minus C. So B minus C, so our principal, our balance at the end will be 19, okay? We're not taking off the interest, we're actually just taking off the difference between the note minus the expense, okay? So that, keep that in mind whenever you look at that. So here's what the journal entry is going to be. Interest expense $14.40, notes payable $42,580. This is the principal and that's the interest, okay? But it does total cash of $56.98. It's paid principal and interest on installment note. Okay, let's see. All right, so here's another one to record the second year. Okay, interest expense of $11.85, notes payable of $45.13. Again, that's the principal, that's interest. Total $56.98. Okay, interest expense the next year is $324. Notes payable $53.74 at a total of $56.98. Okay, so it decreases. This actually happens exactly whenever you pay car payments and mortgage payments as well. It's the interest rate is higher in the beginning and then it decreases over time. Okay, so keep that in mind. Periodic payments. After the final payment, the carrying amount on the note is zero, indicating that the note has been paid in full. Here's another example. They issued a $30,000 10% 5-year installment, and that has an annual payment of $7,979.14. So here's the journal of year 2, 1 and 2 for both. So here's what it looks like. $30,000 carrying notes. Note payable is going to be $79.18. Interest expense of that will be 10% of $30,000, which will be $3,000. So our decrease in note. This is a payment to our principal, so our balance is here. So then next year, we pay the same amount, but our interest decreases. We get 10% of the $25,086, and then a decrease in note of $54.05, so $19,681. So here are our entries. Interest expense $3,000, notes payable $49.14 for $79.14. Year 2, $25.09, notes payable will be $54.05 for a total of $79.14. So here are the balances, and all we have to do is compute it like in the table before. Contingent liabilities. Some liabilities may arise from past transactions only if certain events occur in the future. These potential obligations are called contingent liabilities. The accounting for contingent liabilities depends on the following 2 factors. Likelihood of occurring. The likelihood of occurring is classified as probable, reasonable, possible, or remote. Measurement. The ability to measure the potential liability is classified as estimatable or not estimatable. Okay. So if a contingent liability is probable, the amount of the liability can be reasonably estimated. It is recorded and disclosed. The liability is recorded by debiting an expense and crediting a liability. So here's what this looks like. So 60,000 36-month warranty. Average cost of repair over a period is 5%. So we're going to take 5% of that 60,000. So our product warranty expense is 3,000. And our product warranty payable is going to be 3,000. If the product is repaired under warranty, the repair costs are recorded by debiting product warranty payable and crediting cash, supplies, wages payable, and other appropriate accounts. So here's another example. $200 part was replaced. So product warranty $200, supplies $200, and this is replaced defect under warranty. Probable and not estimatable. A contingent liability whose occurrence is probable but not estimatable is disclosed in the notes to the financial statements. For example, a company may have accidentally polluted a local river by dumping waste products. At the end of the period, the cost of the cleanup and any fines may not be able to be estimated. Reasonably possible. A contingent liability whose occurrence is reasonably possible is disclosed on the notes to the financial statements. Remote. No disclosure needs to be made in the notes to the financial statements for a contingent liability whose occurrence is remote. Okay, so here's the flow chart. Contingent, so probable, reasonably possible, and then remote. So you do nothing for note. reasonably possible, you disclose. Now, when you have to take into account is the likelihood of occurrence, if it's probable, you have to, is it estimatable or is it not estimatable? If it's so, you record it and disclose. Not, then you just disclose the liability, okay? So there's a flow chart. Okay, so I'll let you do this checkup corner on your, whenever you go through, it's on in the book as well. So those are the requirements, and these are the entries for that warranty, contingent liability, okay? Reporting liabilities, accounts included as current liabilities on the balance sheet include accounts payable, accruals, notes payable, the current portion of installment notes payable, any other debts that are due within 1 year. So reporting liabilities, here's an example right here. And here's some quick ratios, working capital, current ratio, quick ratio. These are important to look at these and use these. So current ratio is current assets over current liabilities. And let's see, quick ratio is quick assets over current liabilities. So I'll go ahead and let you rethrow those. And let's see, so decision making, how you use it to compare companies to companies, okay? That's what these quick ratios are for. They're called asset tests, quick ratios, okay? So you compare one company to another company. So that's the end of this video. Thanks for watching. Make sure you get your homework turned in. Thank you.